You are viewing a conversation between Rick Chelko and Dirk Raderstorf about the problems created by conflicts of interest in the benefits industry.
Rick, you've made significant efforts to differentiate the Chelko Consulting Group as an independent consulting firm. Why is independence so important?
To try to represent the best interests of both the buyer and seller creates an inherent conflict of interest. So in forming our firm, what we decided to do was to represent the buyer's best interest and to avoid conflicts of interest.
So how do others represent both?
Well, one of the most common approaches is for brokers and consultants to function what the insurance industry calls producers. And by being a producer, what you're doing is generating revenue for those suppliers. And typically what goes along with that is such things as incentive compensation. They call it contingent compensation or overrides in the insurance industry. And another common approach is to provide additional services directly to those suppliers as customers. Things like data analysis, product development support, market research, and the like.
Well, help me understand contingent compensation. Can you give me a few examples?
Contingent compensation is really just an extra layer of compensation, and it's not client-specific. What it does do is it rewards a firm for growing a book of business. That's what they call a group of clients at the insurance company, or maintaining that book or the book's profitability. It tends to be what they're paid for.
Didn't Elliot Spitzer, the New York Attorney General, take care of this issue back in 2005?
What he did was he made it reportable. And he also, for a period of time, he banned the big three brokerage firms from accepting it. And he also, part of that settlement was, spending hundreds of millions of dollars in fees, returning those back to their clients. But he did not ban the use of it. In fact, the practice is still very common today.
So what is the problem with contingent compensation?
The problem is, first of all, it adds cost for the buyers. It may not be client-specific, but the buyers are paying for it. And the other thing is that it tilts the playing field. I think Elliot Spitzer used the term bid rigging, which is a pretty strong term, but basically it changes decision-making behind the scenes. You can't help it. People are humans, and all of a sudden the process isn't quite as fair. The field isn't quite as level as what the buyer originally expected.
So is this unique just to brokerage firms?
Not at all. First of all, you got a lot of brokerage firms that call themselves consultants. It's probably a subject for another day, but even the major consulting firms over the last number of years have increasingly taken incentive compensation along these lines, and I think the money has just been so significant they weren't able to pass it up.
So why is the Chelko Consulting Group taking the stand when other firms seem to be taking the money?
Well, first of all, it's not in the client's best interest. And we've got a core value that's called the golden rule. So when we put ourselves in the seat of the client, we look at the situation knowing what we know about how the industry works and what it does in human nature. And you and I have both been there before, so you know what I'm talking about. It does impact decision making. So we've decided it's not in their best interest. We're going to be independent. We're going to avoid those conflicts of interest.